busted open, our stock went down to 6. It went from 113 to 6 in less than a year. That whole period is very interesting because the stock is not the company, and the company is not the stock.
Stocks are not backed by the company. That is why investors don't know how much their stocks are backed by. If something is backed, it means you're going to get a definitive amount of money back for whatever you're holding, or there's some kind of accessible collateral. So if Google is trading for $2,000 and the assets on their balance sheet amount to something like $1,000 a share, it would be fair for you to assume that Google stocks are backed by $1,000. The problem is that's not how it works. If you look at their SEC filings, there isn't a single public company that says they will back their stocks by some defined price. So in practice, they don't have to give you shit. Now, hypothetically speaking, stocks are backed in the sense that if Google goes out of business, liquidates, pays back their debts and insiders, whatever's left over will go to the shareholders. The problem is, when the hell is that going to happen? And how much is going to be left over in this hypothetical liquidation? The potential for a future liquidation or buyout are considered unfalsifiable ideas no one can show to be right or wrong. It is pseudoscience nonsense that cannot be used in a logical debate. Hypothetically speaking, anything can happen, but you can't use a hypothetical idea to debate the observable fact that if Google crashes tomorrow, as per their SEC filings, they have no definitive obligation to pay their shareholders anything for the stocks they are holding.